You picture it clearly, a massive steel building humming quietly, forklifts gliding between towering shelves while rent checks arrive every single month. No storefront, no customers walking through your door, just concrete floors, tall ceilings, and tenants who pay steadily for empty space monthly. Buy the land, put up steel walls, and watch rent roll in while everyone else fights for customers in a crowded retail store. That is the tidy dream real estate forums and industrial brokers sell you, the warehouse as boring, steady, dependable passive income forever. Here is what almost nobody tells you before you sign that construction loan and become the proud, exhausted owner of empty space. Owning a warehouse was never really about simply storing boxes for companies that happen to need somewhere to keep their inventory safe. It was about correctly guessing where global trade routes and consumer demand would flow years before construction crews even broke ground first. Start with the number that shocks almost every new investor, the true cost of building a modern distribution-style warehouse today outright. National construction costs in 2026 range from $85 to $200 per square foot for a turnkey facility. A basic 50,000 square foot warehouse can easily cost $4 to $5 million once site work and permits are included. That massive upfront cost does not include land acquisition, which alone can account for up to 70% of total project expense. Location swings cost dramatically, with construction in Portland or Seattle costing far more than similar comparable buildings in Dallas or Houston, Texas. So, what is the actual trap hiding underneath the glossy photos of clean concrete floors and loading docks in the investor brochure? The trap is that rental income sounds passive, but vacancy, tenant improvements, and financing quietly consume much of that income before you notice. National average asking rent sits near $10 per square foot yearly, ranging from $4.50 in Memphis to $22 in Los Angeles. Industrial vacancy climbed to roughly 7.5% in 2026, the highest level in several years of steady growth. Take a real 50,000 square foot warehouse in Houston built for $5 million at a 7% capitalization rate today. That building generates roughly $350,000 in annual ownership value, working out to about $7 per square foot. Compare that to an $8 per square foot lease rate, and the break-even point on ownership stretches out to roughly 10 full years. Clear height matters enormously too, since every extra foot above 28 feet can add 15 to 22% more pallet capacity. Buildings without that vertical clearance simply cannot ever compete for modern automated warehouses that depend on tall, densely packed racking systems today. Before that decade passes, you are simply gambling that tenant demand, interest rates, and vacancy all stay favorable for an entire 10 years. So who actually gets rich from the warehouse you are dreaming about building this year with your hard-earned personal capital anyway? Construction companies get rich first, collecting millions before a single tenant ever even walks through the door to inspect finished space fully. Land sellers get rich next, since scarce industrial zone land near highways and ports commands premium prices that keep climbing every year. Lenders get rich collecting interest on massive construction loans, whether that warehouse fills with tenants quickly or simply sits stubbornly empty instead. Insurance companies get rich charging steep premiums on large structures that carry significant fire and liability risk around the clock every day. Property management companies get rich collecting fees to handle tenants, repairs, and leasing that most owners simply cannot manage entirely alone anyway. Municipalities get rich collecting steady property taxes that climb steadily every year regardless of whether your building sits full or completely empty. Engineering and architecture firms get rich too, billing heavily for specialized designs that meet modern clear height and dock door requirements precisely. And large logistics REITs get rich because their massive scale and cheap capital access crush what any single small owner could ever negotiate. The small independent warehouse owner, meanwhile, often struggles for years just to fill space that construction crews originally finished right on schedule. This is the quiet architecture of warehouse wealth, where construction costs, land prices, and financing all flow upward before real profit begins. The warehouse itself was never really about the steel building sitting quietly on a lot waiting for its next tenant to arrive. It was about who understood global trade patterns, e-commerce growth, and tenant demand well enough to buy land before everyone else noticed. Consider Hamid Moghadam, an Iranian immigrant who arrived in America after the revolution and struggled to find work during the hostage crisis. More than 30 companies rejected him before a former Stanford professor finally offered him a job at a small real estate firm. In 1983, Moghadam co-founded AMB Property Corporation with two partners, a credit line, and a few hundred square feet of office space. His partner Doug Abbey joined at the very start, and he Robert Burke joined the following year to round out the founding team. The three partners initially managed real estate on behalf of institutional investors, slowly building credibility before shifting toward direct ownership themselves entirely. AMB initially invested broadly across offices, shopping centers, and industrial parks before Moghadam made a decisive strategic pivot toward warehouses specifically instead. He recognized that rising global trade and, later, e-commerce growth would demand enormous amounts of industrial space near ports and highways nationwide. In 1997, Moghadam took AMB public, raising roughly $300 million to fund aggressive warehouse portfolio expansion nationwide entirely. Meanwhile, a rival company called Prologis had grown larger but over-leveraged itself and nearly collapsed during the 2008 financial crisis. In 2011, Moghadam orchestrated a merger of equals, with the smaller, more disciplined AMB effectively absorbing the larger, weaker Prologis company. The combined company adopted the Prologis name, lowering the capital L, and became Prologis, the largest industrial real estate company in the world. Prologis kept consolidating, acquiring DCT Industrial for $8 billion, Liberty Property Trust for $13 billion, and Duke Realty for $26 billion. By 2026, Prologis managed roughly 1.3 billion square feet across 20 countries, worth well over $100 billion. Moghadam did not get rich building a single warehouse, he got rich correctly predicting where global trade would flow decades ahead of time. So should you actually build or buy a warehouse this year? Or is this simply another romanticized trap dressed up as steady income? The optimist case looks like this. You secure a well-located parcel, sign a strong tenant early, and rents rise steadily for years. Your building stays consistently leased as e-commerce and logistics demand keeps pushing tenants toward well-positioned distribution space near major highways nationwide. The realist case looks messier. Vacancy drags on longer than expected, tenant improvement costs pile up, and your margin shrinks month to month. You still profit, but slower than expected, and much of your early capital goes toward permits, site work, and unexpected construction delays. The worst case looks like this. E-commerce growth slows sharply, and your massive building sits empty while loan payments keep arriving anyway. You sell the property at a steep discount just to escape financing costs that no longer match what a cooling market can support. A 50,000 square foot warehouse can require well over $100,000 annually in taxes, insurance, and basic maintenance alone. This does not mean warehouses are worthless investments. It means they reward correct timing and location far more than romantic dreams of easy rent. The people who win long-term rarely own a single building. They assemble portfolios that spread risk across dozens of properties nationwide. Scale changes everything in this industry because bulk construction contracts and cheaper institutional financing unlock pricing that small owners rarely ever see. One slow leasing quarter barely dents a massive REIT portfolio, while that same slow quarter can sink a single independent owner's entire year. This is why logistics REITs keep expanding while individual warehouse owners keep quietly selling their buildings and exiting the business entirely afterward. The math simply does not ever lie, even when glossy investor brochures make warehouse ownership look like effortless, guaranteed passive rental income. If you do decide to build a warehouse, treat the first years as a brutal education, not as guaranteed, comfortable passive income. Study your realistic vacancy assumptions, your true construction costs, and your actual tenant demand before ever signing any construction loan agreement blindly. Talk to current owners in your target market, not just brokers who profit the moment your signature finally lands on the paperwork. Underwrite conservatively, assume higher vacancy and construction costs than advertised, and never assume rent alone will bail out a poorly located building. The warehouse was never really about the concrete floor sitting quietly under fluorescent lights waiting for its very next shipment to arrive. It was about the real difference between someone who tracks trade patterns relentlessly and someone who merely owns an expensive, empty building. Real wealth in warehousing rarely looks like the glossy photos. It looks like spreadsheets, land acquisition timing, and patient portfolio building instead. The silent millionaires in this space are not the ones posting loading dock photos online. They are quiet, methodical portfolio builders instead. They are the ones who tracked e-commerce growth, trade routes, and land prices long before anyone else even considered the real math. They understood something simple, that a warehouse is not truly passive income. It is a logistics bet wearing a concrete building costume. That concrete costume is comfortable to photograph, but underneath it sits heavy construction debt, vacancy risk, and relentless property tax bills constantly. This pattern, hidden wealth dressed as simple boredom, repeats across almost every unglamorous industry people overlook while chasing flashier investments elsewhere instead. It shows up in self-storage, data centers, parking lots, and cold storage, wherever boring buildings quietly generate outsized long-term returns. The real money almost never sits with the single warehouse owner. It sits one layer above, with whoever assembled the entire national portfolio. And that is the pattern this channel keeps returning to, again and again, the silent, unglamorous truth hiding behind every boring financial dream. If warehouses taught you anything today, let it be this simple lesson: look past the concrete floor and study the actual trade patterns. Because somewhere behind every single pallet ever stored, someone else already quietly built the system that profits before you ever even do. That is the real lesson of the silent millionaire. Wealth always prefers structure, timing, and patience over excitement and easy, quick promises. Next time someone romanticizes owning a warehouse, remember Hamid Moghadam's 30 rejected job applications, not just a single gleaming loading dock somewhere. His empire came from correctly predicting trade patterns and patient consolidation, not from personally stacking boxes in a warehouse decades ago either. Somewhere right now, a quiet operator is studying trade route data nobody notices, while someone else photographs a shiny new building for social media. That quiet operator will very likely still own warehouses in 20 years, while the flashy single building owner has already sold at a loss. This is not a reason to avoid warehouse ownership entirely. It is a reason to approach it with humility, math, and patience. The warehouse can absolutely build real wealth, but only for people willing to treat it like a logistics bet, not a hobby. Every number in this video came from real industry data, real transactions, and real companies that actually built lasting warehouse fortunes over decades. Hamid Moghadam started with 2 partners and a few hundred square feet of office space and built the largest logistics company in the world. You do not need his exact scale to benefit from his lesson. Timing and patience beat excitement in nearly every warehouse decision. The next time someone shows you a shiny new warehouse online, ask about its true vacancy risk before you ever ask about the ceiling height. Ask about land acquisition timing, trade route positioning, and realistic vacancy before you ask about the number of loading docks out front. The silent millionaires already asked those boring, unglamorous questions years ago, quietly, without an audience, long before they ever profited from warehousing. That is exactly why they are wealthy, and why so many louder, more excited investors are still absorbing their very first vacancy shock. None of this requires enormous luck. It simply requires patience, honest math, and the discipline to track every single trade pattern shift. Most people who build a single warehouse regret it, not because the building disappointed them, but because true costs never match projected income. Regret rarely comes from the concrete itself. It comes from fixed costs that kept arriving whether tenants filled the space or not. Wealth built around warehousing consistently rewards timing over excitement, patience over impulse, and honest math over glossy loading dock photographs posted online. The dream of the warehouse is not entirely fake, it is simply incomplete, missing the relentless vacancy risk hiding beneath the concrete. That missing risk rarely appears in glossy investor pitches, because vacancy does not photograph nearly as well as a fully loaded loading dock. Fill in that missing math honestly, and the dream slowly becomes a real, sustainable business instead of an expensive, disappointing financial lesson. Every silent fortune in warehousing was built the same quiet way. One honest trade route prediction, one careful decision at a time. That pattern holds true whether the portfolio spans just one building or spans 1.3 billion square feet across 20 countries. Warehouses, self-storage, data centers, and cold storage. The packaging always changes, but the underlying architecture of who profits first stays identical. Understand that hidden architecture just once, and you will start seeing it everywhere else that money quietly moves, far beyond warehousing itself. That is the real education hiding inside every warehouse story, far more valuable than any single square foot you could ever rent. Because once you finally see who profits first, you can decide, with clear eyes wide open, whether you want to play this game. And if you do choose to play it exactly like Hamid Moghadam, with patience, structure, and total contempt for the easy dream. The silent millionaire is never the loudest voice at the loading dock. They are simply the last, quiet operator still standing after the cycle turns. Subscribe if you want more stories exactly like this one, where we quietly take apart the loud dreams that everyone else keeps selling. Because the real money was never inside the building everyone loves to photograph. It was always hiding in the trade patterns nobody discusses. And that pattern, hidden in plain sight the entire time, is exactly where this channel will keep looking for the very next silent fortune.